Okay, good morning, everybody. Hope everyone had a great Memorial Day. I know we did. It was a beautiful day and nice to be outside and spend a little bit of time out in the sun. And I feel like in Pittsburgh in the summer, you got to take advantage of as many of those days as you can, because after a long winter and being shut in for a long time, it really made it for a little while. So I hope everybody else enjoyed that. Thanks for joining in, and today we're going to talk a little bit. Have we maybe possibly taken a turn for the better here with the economy and the markets? And a couple key pieces of economic data have come through today, actually, and the markets this week have reacted favorably in general. We'll talk a little bit about that and raise some questions of whether or not that's the case. So first, just to kind of give a little bit of recap, last week, the S&P had a pretty good week, and so did the Dow. The Dow was up over 3%. NASDAQ was up over 3%. So pretty good week in the markets, and pretty much erased the previous week's loss that we had seen the week prior. The S&P index is now down less than 7%, which is pretty surprising and pretty amazing. And really, it's up now since the bottom in March. I think the bottom was March 23rd. It's up close to 35% from its low. And this past Monday, we had the best performance since early April, with the markets up over 3%, and a lot of that strength coming from energy stocks, oil stocks, et cetera, really helping. The equity markets were boosted by reports for COVID-19 trial vaccines. That certainly helped, and positive comments from the Federal Reserve Chairman and some of the things going on in the central banks. So that certainly was all positive, I think, in the markets last week, and the start to this week were very favorable. Some new information just come out that I think is worth noting. Building permits and existing home sales all reported double-digit month-over-month declines for April, but we're starting to see a pickup, and we'll talk a little bit about home sales in just a second. The other thing that was relatively not unexpected is U.S. initial jobless claims still remain historically high through last week's 2.4 million, which is the lowest weekly claims number that we've seen since March, but still certainly pretty dismal. And so I think, now really the biggest debate in the economics world is whether or not the worst of the pandemic shock is behind us or not. And I think that's kind of the big question. But two pieces of information just recently released contribute to, I think, news that suggests that there is a possibility that the bottom is indeed in. It's not certainly guaranteed, and we'll know when history is behind us. But it doesn't necessarily look like the data is getting worse. That's not necessarily a good thing, because it's maybe not getting quite better per se. But certainly, I think that there is some light at the end of the tunnel when you don't see data really getting worse per se. So just recently, as of this morning, the consumer confidence, which is an important factor that many economists look at, it came back favorable. It was up, as well as new home sales data, and they both topped expectations. So it seems at least that few economists are wondering how bad things will get. I think, we kind of already have seen that. That question's been answered, although probably not necessarily anybody expecting a V-shaped recovery at this point. It doesn't look like things are getting necessarily worse. And again, although that's not a good thing, it certainly gives us some perspective as to maybe where we are in this recession and in this potential recovery. And amid historic drops in employment activity, it's nice to see at least some potentially be over. And we're starting to see other pieces of information that are coming in that at least looks favorable. The government had pretty much everything shut down for so long, and I think time will tell whether or not that was the right move. Certainly health and the well-being of everybody is extremely important, and I'm not here to debate what's right and what's wrong from a healthcare perspective, but I do think it will be interesting to look back in time and see whether or not that government shutdown would have been the best situation or not. And it's a difficult story. But now that states are starting to loosen up government-imposed restrictions, and states are turning from red to green and red to yellow and yellow to green, we're starting to see some shoots of economic life. Rail car traffic, hotel occupancy, motor vehicle, gas purchases, air travel, they're all down from a year ago, but they are very much moving above their lows. Just a couple examples: hotel occupancy is up 9% from a month ago. Gas purchases are up almost 30% from a month ago. People are definitely starting to get out and about more. The number of passengers going through TSA checkpoints at airports, this is one that's been very heavily watched. It rose to 267 plus thousand this last Sunday versus the low, which was 90,500. And it's definitely moving up. And this Sunday was a holiday weekend. And last Sunday, it was up over 180% from its high. From its low. So in order to tell whether the overall economy is starting to recover, we do look at a couple other different kind of key places. One is the unemployment claims that I mentioned. The other thing you can look at is federal tax receipts, which I think is an interesting one because it kind of shows kind of what the pulse of the working environment looks like. The bad news is unemployment claims have continued to elevate. We've talked about that in the past, and it's, I think, going to be somewhat of feeling like a hangover as people re-enter the workforce, even if they do, considering a lot of people are actually making more on unemployment. And we talked about this, I think, pretty early, whether or not this could be a potential issue and concern, and it's starting to already look that way. But it's kind of hard to see exactly where that comes, because typically the average level for initial claims peaks before the economy hits bottom. And April looks like it was the highest month for initial claims, which signals that the economic bottom should maybe come in June. Again, we'll kind of see if that stays the course as it has been historically. What's also pretty clear is this recession is not like the other ones, though. So, we're watching unemployment claims continue to rise, and there's a question as to what that will look like. Typically, we see these things peak before the economy is completely bottomed out. So if they do peak soon, I think that's a good sign, because it's usually, like I said, a 1, maybe 2 month period before we start to move up in the right direction. Unfortunately, continuing claims haven't peaked yet. Probably won't for a little bit more time, but it's definitely one thing we're kind of keeping our eye on. If we talk about tax receipts, that's kind of the daily flow of money, payroll taxes being withheld, being sent to the federal government. I think this is kind of an interesting one. Using tax receipts to figure out economic trends can be difficult, though, because not all years and months and weeks are the same. Some months have 5 weeks in them, and their calendar days are a little bit different. But I think this is interesting, and that's why I wanted to bring it up. If you go back in time and you try to find a recent calendar year that looks like it does in 2020, the closest one is 2015. So 10 of the 12 months have the same number of days, and the same number of weeks, including a leap year. So it's easy to make that comparison, I think, to 2015. So where does 2020 stack up to 2015? And what does it show? So in the first 3 months of 2020, January through March, withheld income and payroll tax receipts were up almost 20% from 2015, which I think everybody would expect. We've been in a booming economy in that period of time. Job growth was continually increasing. And when you add in kind of what you would expect from an inflationary perspective and job growth, I think that's a reasonable expectation. So receipts in April 2020 were only up about 2.6% from April 2015. So now you start to see the drop in that just massive cliff of economic shutdown. So where that trend had been almost 20%, now we're looking in April about 3%, not even. The good news is that so far in May, through last week, those receipts are up 2.9% versus May of 2015. So still not good, but less bad. And that seems to kind of be the key here, is less bad. Just like some of the other things we've already spoken about on this call, it's not worse. It's just less bad. And that could be at least some, it's kind of like we're just past spring, where the leaves or the trees are budding and the leaves are coming out on trees, and we're starting to see some growth, and that could be a signal of more economic activity. The recession started in March. We know that from the data now, and it was the deepest since the Great Depression. However, it might possibly be the shortest. And a full recovery is certainly a long way off, and we probably won't see the level of real GDP we had in late 2019 again until probably late next year. And we might not see unemployment come back to where we were at below 4% for a long, long time. Some of the economists are saying 2024. But with every passing day and every new breakthrough in vaccine trials and states continuing to test and lockdowns starting to continue to move from red to yellow and potentially green, the sooner those things start to come to fruition, I think the pushing this boulder up that hill and eventually getting down the other side. And I guess kind of where I just wanted to kind of bring out some ideas today was there is some glimpse and some light at the end of the tunnel that maybe we are close to that boulder being at the top of the hill. How much further is really difficult to know, but at least we're starting to see some very reasonable signs that, hey, it's not worse. In fact, although it's not good, it's definitely better than where it was. And the markets have certainly been favorable to that, as I'm sure you have seen if you keep pace on at least what the major indexes are doing, Dow and the S&P, et cetera. But I think that's really where we're kind of at right now, is just trying to identify what potentially where we are in the cycle. Had you been on calls a couple weeks ago, myself, Melissa, as well as some of the analysts or economists that we've had on as guests, we've all kind of dabbled in whether or not there could be new lows. And obviously anything is possible, and we certainly don't know what the future brings. But I think since then, there's a lot less probability that that's a factor. Doesn't mean we won't have volatility. We'll certainly continue, I think, to have volatility. But I do see, and a lot of the economists seem to agree, in fact, I'd say most, that most likely the worst has kind of been written in the history books. And now it's more a matter of how long does the recovery take how quickly do we see a U or a V, and when does the data start to be like, okay, it's not worse, but it's not necessarily great, to, okay, now we're really making progress, and we're starting to see these numbers come back to normalcy. And I think most of these economists expected there's still a lot of work to be done, certainly. But it's looking like there's some light at the end of the tunnel from a stability of the economy and the stability of the market's perspective. And it's nice at least to see some of that data start to peak out. Still kind of have to look for it, especially with the unemployment numbers. But that's why I wanted to kind of at least bring it up, because I think Melissa and I this past week and very recently, even as of this morning, have at least been pleased with some of the positive news that's come out. And of course, obviously, with at least the markets moving back a bit more, helps, I think everybody, especially emotionally, clients and their futures and their accounts. But from an economic perspective, I think we're starting to see some signs of life, and that's important. So that's mainly what I wanted to talk about today. Just a couple pieces of information. We're working on a series of calls that we're going to have very soon, where we're going to bring in some different experts from different areas on kind of different subjects that clients may be interested in. So keep your eyes out for more communication on those. And if you'd like to join us for any of those calls, please jump on. They'll be a little bit more specific in nature. So we can definitely kind of figure out what that looks like and get you that information as soon as possible. So we're working on that right now. Just trying to think, Dan, the other updates. The Steinwolf office is kind of operating in the yellow phase right now. So we are open. We're minimally staffed there for everybody's protection. We're still trying to keep client interaction physically in the office to a minimum, but the office is open. We are available, of course, even if we're not in the office, as we have been, but we're working on a good, safe plan for kind of a re-entry to getting back to normal. And we're actually going to send out a questionnaire to everybody to get some feedback as to their thoughts on how they'd like to start seeing their regularly scheduled meetings, whether they want to have it in person or they want to do it over the phone or a web meeting, just to get some feedback from everybody so we can take that into consideration as well. So keep your eyes out for your email on those various correspondences. We'll be working on those. And for everybody who's taken part in some of our fun Facebook polls, we appreciate your contribution, and thanks for participating in those. And so thank you, everybody, for joining on the call. We appreciate you coming on. And, of course, as always, if you have any questions or any follow-up from these, feel free to give us a call and reach out. So everybody enjoy the rest of the week, and we will talk to you soon. Thank you very much.